The bank's code. This is the Smart Money Concepts Market Maker methodology. 90% of traders lose consistently. If they had to just do the opposite of what they are doing, they would win consistently, right? The market is either going up or going down. It's either a buy or a sell. You have a 50% chance of winning in every trade. If you really have a 50-50 chance of winning in every trade, why do 90% of traders lose? Think carefully about this question. You are being manipulated into losing. How, you might wonder? Well, let me tell you. How are you being manipulated in the markets? Through FOMO-induced trading trickery that makes you trade emotionally, causing you to make the wrong decision at the right time. Your best friend and your worst enemy is your mindset about how you believe the markets really work. This pattern is the holy grail and allows you to see the true intentions of the markets and understand how this manipulation game actually works. By knowing this pattern is unfolding in the market gives you the biggest edge into not falling into this trap. This is how it works. See, price goes into the contraction phase where we get this simultaneous lower high and higher low occurring in the market. See, this is a higher low and this is a lower high. It forms this squeeze where price starts to get smaller and smaller. This is the first phase in the market, the contraction phase. Then we get price breaking out of the box, up and down, up and down. This is the second phase in the market called the expansion phase. As soon as price whipsaws above and below this box, we get a value line that's drawn out the center of the box. This is also called a major expansion line. This is the 0 point in the market where the market makers balance their book of business. It is an equalizing of price where supply and demand become equal. So first we get the squeeze. Price squeezes. This is where low institutional volume starts happening. And that is where we draw a box around this contraction phase. As soon as price breaks out the box, that is the sign that the expansion phase is starting. This lets us know that there's incoming volatility that's starting to happen. Price breaks above the box and below the box, which confirms this value line or this major expansion line. This gives us an accurate barometer by which the market makers are utilizing as their 0 point or their gravity points where they will move price above and below in order to fill their massive position sizes. This second phase is also known as the manipulation phase, and this is the phase where most retailers get liquidated and get caught in this emotional trap where they make the wrong decision at the wrong time. As we get this whipsaw up and below, we're going to get these liquidity lines that are formed, are going to show us exactly where the retailers are keeping their stop loss levels. These are floods of buy and sell liquidity resting in these areas. As price starts to whipsaw above and below the value line, these liquidity lines will form. These liquidity lines are showing us where there are pending stop loss orders resting. Floods of liquidity are resting in these areas. This is precisely the places where the mass market is going to make a mistake. And this is where the market makers look to take their entries. You see, because the banks, the institutions, the hedge funds, they trade with such large amounts of money, the only time they can get their orders filled is when the mass market makes a mistake. And these stop loss levels are resting in these liquidity zones. Let me tell you how this manipulation actually happens. Price goes into the contraction phase. As price breaks out of this box with this incoming volatility going into the expansion phase, price will break out of this box, usually with a big buy candle. The retailers will immediately think that price is going up and they will enter their long positions they will enter their long positions over here, and they will set their stop loss levels below the previous swing low. So there'll be stop loss levels resting in this area. They will enter their long position over here. And what will happen? Price will burst out with this big candle and then suddenly reverse, dropping down and liquidating those buyers over here. Then as price breaks below the value line, liquidates all those longs, and then the mass market thinks price is going down. So it opens a short position over here, and they set their stop loss levels over here. And then what does price do? Price reverses again, turns against them, breaks up, and liquidates them once again over here. As price breaks above the value line again, the mass market thinks price is going up. So they enter their long positions again at this point, and they set their stop loss levels over here at the previous low. Then what does price do? It reaches the previous short position holders stop losses and liquidates them and reverses, going all the way down and then liquidating those people who entered their long positions over here. As price goes down again, crossing the value line, the mass market thinks price is going down again, so they enter their short positions and they place their stop loss levels at the swing high. Price hits this liquidity zones. All the people who entered their long positions over here get liquidated, and then price reverses at these points again, going up and liquidating those short holders over here. As you can see, this cycle happens over and over again. This is the expansion phase. This is precisely the manipulation phase. And this is the exact pattern that the market makers use to accumulate their massive orders. Because they play with such large position sizes, they need to break down this pattern into a sequence where they can get their massive position sizes filled piece by piece. At each level here, they are filling their position sizes, accumulating, and accumulating until they have accumulated and they filled their complete position sizes, which can usually be tens of millions or hundreds of millions of dollars. Once all their positions are filled, by tricking the mass markets, you see, the only time they can get their positions filled is when opposite side of the market makes a mistake. Because if they're looking to buy and accumulate buy positions, they need the retailers to sell to them, and they have to create a setup where the retail will sell and they'll purchase it from them. And this is precisely how they do it in this sequence. If you don't understand how this pattern works, you will consistently end up on the wrong side of the market, how I previously explained. The wrong way to do this is to buy above the value line. And the wrong way to do this is to sell below the value line. That is the wrong way to do it. And this is the way 90% of traders are actually operating in their trades. And this is why they're consistently ending up on the wrong side of the market. Price breaks above the value line, they're buying. Every time price comes above the value line, the retailers who are losing are buying. Every time price goes below the value line, the retailers are selling. This is completely wrong. The right way to do it is to only accumulate buy positions underneath the value line. And the only time to accumulate sell positions is above the value line. This is the opposite of what most retail traders are doing, but this is the exact way that the smart money and the market makers are operating in the markets. And in order for you to win consistently, you have to align your strategy with the strategy of the market makers. This expansion phase over here that I'm showing you is the key to unlocking your potential to winning as a trader. Once the market makers have accumulated all their positions through this pattern, they will drive the price higher, and they will go into the third phase, which is the trend phase, the profit taking phase. And then they will start taking profits on their previously accumulated positions, which were the liquidations of the retail traders. The market makers, they require you to make a mistake in order to fill their positions. So it's completely important for you to be caught in the wrong side of the market for them to actually benefit. This pattern I've just revealed to you will allow you to start to think the opposite of the way that you've been traditionally taught to think, and to open your eyes to this smart money concepts way of trading, where you align your trading style with the market makers.